Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, December 7th, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Big changes today across the board in the market. You can see the state has been changed to rally attempt as of today, and if you check over here on the trend gauge, you can see we've upgraded leadership from bearish slash downtrend to neutral, upgraded the short-term trend from downtrend to neutral, and have arrows pointed toward bullish. So lots of changes over the last couple of days. Let's step back to Friday. So we were undergoing a correction last week. Not the best of days on Friday, down 1.7% on the NASDAQ, 0.8% on the Dow, but we did finish off of the low, so a little bit of strength into the close. We came into Monday morning with a minor gap. NASDAQ stocks were lagging. Dow Jones gapped up 1%. S&P gapped up 0.7%, and we finished near the highs of the day. So it was a broad rebound, and it was the first attempt to stop the downtrend. However, we'll look at the charts in a little bit, and you'll see that we ran into declining moving averages, most notably the 21-day exponential moving average that has been capping any strength. But a big change happened today overnight. We had a big gap up, 1.2% on the S&P, 1.8% on the NASDAQ, and that gap took us above the 21-day exponential moving average, and strength persisted throughout the rest of the morning. Then we went sideways, tried to sell off into the close, but had a nice bounce into the close, and this is a change in character for the market, change in character for leadership, a change in character for the short-term trend, and definitely got us from being defensive back to market participants again. So we'll take a look at the 7 stocks that survived the 21 over 21 purge last week, as we saw lots of sell-offs. Some of those charts are hopelessly damaged. In the 14 that dropped, some of them are staying on our watch list, but we added 3 from the survivor list, and we'll talk about those, and we'll also talk about getting back above the 21 and how we exited and took a loss on our hedge on that. So what just happened? As you see, big gap above the 21, strength persisted. G5 very strong. This is what gave us some confidence into buying into this rally, up 4.08%. S&P strong, up over 2%. NASDAQ 100 up over 3%. Dow up 1.4%. Mid caps 1.7. Russell up 2.28, and across the board, mid, small, and cap growth outperformed value. Let's get into the market facts, but let's first get into the team here running Revere. I'm also going to, as part of this video and part of the facts, set expectations for what type of market we're in and what type of performance we should expect to see out of our approach to the markets across various market types. And if you're interested in an approach like this, one that participates in market uptrends, takes defensive action when the market threatens a downtrend, we take baby steps out, baby steps in. Sometimes we have to take bigger steps as if there's a drastic change in the market, but it's okay to be wrong. It's not okay to stay wrong. We want to stay in sync with the market. That's why we put a lot of cash to work today in the market. If you're interested in this approach, you can email any of us. It's our first name at revereasset.com. So that's Dan, Tim, Hunter, Muriel, Alex, or Don at revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. So first of all, let's get to the charts of the indexes, and then I'm going to talk about some expectations. We're up the last couple of days about 1%, which very clearly trails what the market is doing, and that's part of our approach when we go from defensive back to offense. It takes a little bit to turn the boat around, and we're going to talk about that a little bit. So here's your S&P 500. This green line here is the downtrending 21-day exponential moving average. So the first big down move was on 11/26, the day after Thanksgiving. We broke below the 21, tried to rally back above it on Monday the 29th, one close above. But then the next 5 days, actually the next 6 sessions, were spent below the declining 21, and any attempt to get back above it was rebutted. So until we get back above the 21, we watch this moving average and we focus on it like no other, because this is really the moving average across the indexes and across leading stocks that sets the tone for a truly healthy versus a so-so versus a below average market. So any rally attempt you can see trying to get above the 21, this happened on Friday. It happened on Monday, a nice up day where we held the 50. So that was a little bit of a change in character. We had been playing ping pong over 4 sessions, closing below, then above, then below or right on, and then back above the 50-day. But until we cleared the 21, which we hadn't for the prior 7-8 sessions, we weren't interested in getting fully long in the market. In fact, with some of the decimation that we saw in the leaders, we were very much in protective mode with our capital, and just a couple of percent from getting stopped out on everything. But as the market does, it held support here around the 4,500 area. This ping pong back and forth between the 50 was resolved today very strongly to the upside. And now we're looking at resistance from the prior highs, trying to get above this 4,700 to 4,720 area. So let's take a look at the facts here. Headwinds in the market, still dealing with a strong dollar, this COVID Omicron, and inflation fears. However, news over the last couple of days seems to be that Omicron is perceived as really less of a threat to anything. You saw reopen stocks rally strongly yesterday, saw a follow through broad rally today. So the next thing that we're left to deal with is the Fed and tightening and inflation, and the market's shaking that off right now. The put call ratio still on the high side at 0.95, but the fear and greed has risen from, I think it was 17 to 35 over the last 2 sessions. So our bull case, as always, want to stay above the 21 and the 50-day. We got back above there today after, as I detailed, several sessions, 7-8 sessions battling below the 21 and back above and below the 50-day moving average. Our bear case, a break below that prior all-time high you can see over here of 45.46, which we threatened, but 4,500 held, and now we're back above, and we do have seasonality in our favor. What I was looking for coming into today, I always want to set an expectation on what I'm looking for, and I was focusing on what was the reaction to the gap up going to be. We've seen several gap ups over the last week and a half fail miserably and close at the lows. This one, however, very positive, showed strength and then the late day pullback. Let's take a look at this on a 5-minute chart here. So you can see 5-minute, the big gap up, strength into 1130, go sideways right around this 4680 to 4700 area. Attempt to sell off over the last hour, but bought going into the close. So good job for the bulls here. Now we want to see on the bears, they'll want to see this gap filled right away and a prompt failure. So that's what we'll be keeping our eye out for over the next couple of days. But for now, also note the 21-day exponential moving average has stopped its downtrend and rolled back over and is heading higher. So that's really what we're keeping an eye on. The gap up reaction stayed positive. Gap above the 21, strength persisted during the day, strength in the G5, strong closed. Our portfolio, we increased exposure. We came into the day at 0.19, so 19% of the risk in the S&P 500. We're off sides, obviously, with the big gap up. But, I mean, that happens. That's not a problem. We had a hedge in place that kept us this low. This was a 15% SPXU hedge against our 30% S&P long. Why do we just hedge? Why don't we sell? Well, we've got a lot of taxable accounts. for one thing, and we don't want to pay the taxes on some big gains that we have in this. The other one is it's hard psychologically to go from buying to selling to buying back in. And part of our portfolio strategy is to hold this 30% long position in the S&P 500 via the SSO. And that gives us the equivalent of, if we held only that and we were all in cash, that's the equivalent of a 60-40 portfolio. Then we take the rest of the portfolio and look to outperform the market with growth stocks or bonds, if that's what it calls for, but we haven't had a call for that lately. Growth stocks or strong sectors that are participating. We've been in some oils lately. We've been in some metals lately. But a big jump up here, closing that hedge, getting back to the 30% long, the equivalent of 60% long on the S&P 500, and some buys at low risk entry points. The gap up on the Q was bought via QLD, and then two survivors from the 2121 list, ZIM and QCOM, and then one that was just on the outside, ANET, that I had been keeping an eye on. So those were three that we added today to the portfolio. QLD, hedge removed, and our exposure goes from 20% of the S&P to slightly over the equivalent of the S&P. Now we'll wait and see if we've got a gentle pullback that'll give us some opportune areas to add to some growth stocks that we've got on our watch list at low risk entry points. Or if we fail, we'll very quickly get back out of the things that we recently bought because they were low risk entry points. And if necessary, we break back below the 21 and these recent lows will go to defensive mode. But as of right now, broad rally, sector strength. Semiconductors, cloud stocks, and oils were strong today. Really, the only weakness was in bonds. We closed at 46.87. That puts us back above all the moving averages. The next resistance area that we're keeping an eye on was this prior all-time high area here. Let's bring it up on a 30-minute chart. Actually, let's bring it up on a 60-minute chart. And it's this 4680-ish area to 4719, 4720, where we've been battling back and forth, trying to get above it, failing, trying to get above it, failing. And then before this recent 1, 2, 3, 4, 5, 6, 7, 7-day correction, pretty harsh correction, really difficult correction if you want to look at it from the standpoint of growth stocks. Here's the IWO. You can see the correction and growth started even before that. And let's take a look at ARK-K. This is had a nice bounce today, but very harsh pullback in that also. So S&P 500. Keep an eye now on this next resistance area, 4,700 to 4,720 on the upside, and to the downside, the 21-day exponential moving average, which we got our first close back above today, and then the recent lows, and that corresponds also with the 50-day moving average. These were broken twice, but we reclaimed them. So the levels and the support levels just keep going up, just keep going higher from a moving average perspective. And then you've got vertical or horizontal support, that 45, 46, a very key, and the 50-day moving average is now above that. So that's a plus for the bulls also. So on the downside, the 200-day moving average, we're back above. We got within, I think, 5.5% of it during the pullback. And now 8.7% above it. And you know from the bear studies, if you follow me close enough, only on a sustained break below the 200-day moving average does the market get into serious trouble. We strive to keep our drawdowns from around 8% from the top, with some rules that we put in place following a big stealth market in growth stocks, stealth bear market in growth stocks in February, March, April of this year. And we're happy with the way the portfolio responded during this last pullback, locking in gains from a 13% move up from 1022 when we came off of the lows. So what's next? We will let the market tell us what's next, just like we let the market take us out of leaders. But certainly two nice days today. We sandwiched that with an update on Friday and a move off the low, an update on Thursday, back above the 50-day, a move off of this 4,500 level, which now in hindsight looks very big. You can see it held 3 times. And again, we'll let the market keep us in or take us back out. We know the growth stocks can drastically outperform the market when we have the right market conditions, and that's what we're looking for now, is the right conditions. So here's the the QQQ. Note, 2 attempts to break below the 50, and it couldn't do it. Now a gap above the 21 today. We'll see if we get follow through on this. Let's go with the Dow Jones Industrial Average. This tested and held the 200-day moving average 3-4 times last week, and held it very nicely. Would have been a great low risk entry last Thursday or Friday, and you see the 2 gap ups on the Dow. Some nice strength there. After a big period of underperformance, like 6 weeks of underperformance, it doesn't take much of a move to get it back near all-time highs. So that's what we're seeing now in the Dow. And mid caps, we had one close below the 200, one close on the 200, back above all moving averages on this 2-day rally here, and the 21 going to flat now from the downtrend. And now finally, small caps. The big day today is in IWO. The growth portion of small caps was up 3.3%, while value was up 1.4%. But the strongest of the growth stocks, the G5, you can see here, up 4.08%, and that's what gave us some confidence to jump back into this rally. Now, now that we looked at the charts of the indexes, I want to bring up something, expectations, and how does our approach perform relative to various types of markets that we're dealing with. So anybody that knows us knows we're pretty quick to get out of things if the market and the growth portion of the market starts to head south. We got hit pretty hard early in 2020, put some process improvements in place to recognize that quicker and take quicker action. And that process really did a good job over the last couple of weeks getting us out early. That's a combination of the G5, monitoring those ETFs, as well as what's going on with our individual holdings. And anybody that knows growth stocks knows that when the hedge funds decide to pull the plug, these can fall really quickly. We've detailed some just devastation and some charts of what were leading stocks over the last couple of weeks. But here's really what the expectation should be with our approach in the different types of markets. So a strong bull market like we saw starting in April 2020 to January of this year. GROTECTION, our flagship portfolio, major outperformance versus the S&P 500. And this is because we know that in a strong bull market, growth stocks will outperform the market, some of them by 10 times, some of them by a minimum of a factor of 2. And that's what we're looking for, something that is at least going to have a factor of 2 outperformance. And an example, as I said, from April of 2020 to January of 2021, we had major outperformance. 2020, we were up 47% in GROTECTION. However, that carried over into January and early February, but then we had a big period of underperformance as we had a harsh pullback just in growth stocks. So another example, next type of market I want to talk about, just an average bull market, not an overly strong bull market. We would expect to see minor outperformance. A good example of this is October of this year to early November. We off of the bottom, we were up about 13% versus 8% for the market. So nice outperformance there. That's what we would expect in a bull market. So what happens though when those bull markets have growth, harsh pullbacks in growth stocks? And this is what I want to focus on. The old pullback we saw major underperformance from February to March of 2021. And as I mentioned, and I did a webinar on this, this prompted us to take a look at our process, see what we can do better, how we can more quickly get out, led to taking a little bit of risk off the table, adding larger positions, larger core positions to the S&P 500. And that's because when you rotate among sectors, that rotation takes place all within the 50-day, all within the S&P 500 from one sector to another. So keeping that as a big core positions cuts our volatility way down. So we witnessed underperformance that we don't want to see again, and now we just kind of saw a very quick, harsh growth pullback in late November into the first couple of days of December early this year. And minor performance is what we're targeting, and that's what we saw. Really, with the market being down 4 to 5%, we were down 6 to 7%. We're quite okay with that as we transition from a strong bull market into a correction. Now, what happens with that correction after that dictates how we're going to proceed next. So let's go to, if we've got a broad bull consolidation, we're also expecting, and really this is just a pullback in markets. Very often growth stocks get hit harder. So we would expect some minor underperformance. And when I talk about minor, I'm really talking about over a monthly basis, maybe 100 to 150 basis points of underperformance. And we're fine with that, with the approach that we have. A broad, mild correction, we would expect to be about in line with the S&P 500. This is what we witnessed from October to November of 2020 last year, when we took a break. Leading up to the election, we got out and handled the consolidation, and some of the pullbacks weren't as harsh in growth stocks as they were over the last couple of weeks and in February and March, and we stayed in line with the S&P, which is pretty much what our expectation is going to be. If we have a moderate correction, say a correction of 10 to 20%, though, we're going to expect that we have minor outperformance. And the reason for that is that 8% target that we set for our drawdown level. We came close to it a couple times during these most recent pullbacks. If we're out at 8% and the market corrects down to 10, 15, 20%, that's some pretty good outperformance there. And if it goes into a bear market, such as in February to March of 2020, like we saw with COVID, we're going to have major outperformance where we were down at, our pullback there was in the low, like 11, 12%, while the market was down 34% over 5 weeks. So that's crisis alpha. And in a strong bull market and also in a strong bear market, we will see major outperformance in our portfolios. If we go from a correction or a bear, the early part of the recovery to that, and this is something that we just saw in the last couple of days, we're going to have minor underperformance here. In this case, the S&P up about 3% over the last 2 days. We're up 1%. I'm fine with that because I know if this continues, again, we're going to outperform if we get into a strong bull run. And if we're not, we're going to be cutting quick because of the low risk entry points that we make. And this is our approach across all markets, tested, and examples are these periods here. I'm probably going to do a webinar on this over the next month or so, where I'll go into a little bit more detail. But the big change here was what happens if you have a harsh growth pullback, where we prior were at risk of major underperformance. Now we've proven that following the rules in late 2021 in the first couple of days of December, late November and early December, that we got out with a minor underperformance, and then we'll pivot, and we'll get back into participating in whichever type of market opportunities come to us. So that's a review of expectations. It's also a review of the indexes. Now let's take a look at the 7 survivors from the 21 over 21 list last week. We still have a position in NVIDIA. Look at the 2 big hammer candles here off the bottom yesterday and following through to the upside. We held a piece through that. Another one that survived, BLDR. Nice move today, but it reversed off of lows, was up at once almost 10% on the day, but showing relative strength. Just got a little bit ahead of itself. This is a construction stock. Next one, Nucor NUE, held above the 21 to close last week. A little bit of follow through, not the strongest, but nice setup there relative to what's going on in some other stocks in the market. New leader, Pure Storage, PSTG, is another survivor. Making new highs. It's very strong. Not in this yet. One that we did buy today that was a survivor is Qualcomm. Note the pullback. Lighter volume than the two up legs that this had. So this is a very natural pullback to the 21. Bounced nicely and back above the 8. Bounced off the 21. We took a position in this today. That's one of the two that we bought. Roblox also. Didn't buy it today, but it got back above the 21 at the close yesterday, but reversed off of this 120 level. Zim was the second survivor that we took a position in. You can see how this nice relative strength during this pullback got to the top of its pivot, pulled back a little bit from there. Nice volume in it today, so we took a 3% position in this. And then one that was on the outside looking in that we bought today was ANET. You can see this had the nice big volume gap up on earnings. Went sideways a little bit, pulled back along with the market and growth stocks. A couple closes below the 21, back above the 21 today. I like the look of this, breaking the downtrend line. So those are the three that we bought today, and those were the 7 survivors of the 21 over 21 list. A lot of stocks have set up very nicely in recovery over the last couple of days. We're focusing on the ones that didn't get slammed. For example, something like CrowdStrike is not something we're interested in. Decent bounce over the last couple of days, but this chart has been absolutely bludgeoned. But we are interested in things like Ambarella, which we owned. We closed below the 21. Actually, we got below the 21 and stopped out of it last week. We had this big gap up and the harsh reversal. That's when we got out of it. We undercut the 21, but got back above it on Monday, and a nice move higher today on almost double average volume, something we're looking to get back into there. And got 15 or so more stocks that we're looking for decent low risk entries on. I'm not going to buy 15 of them. We will be looking. We still also own Apple, so we've got 5 in the portfolio. Apple and Nvidia were the only survivors. Apple, you can see all-time highs today. Like the look of that. But we'll keep an eye out for opportunities for the rest of the week, or if the market reverses, we'll obey our stops as always. And pretty long video today, but a lot to cover as we flip from correction mode back into bull mode. And I wanted to review the expectations and how our portfolios react when this happens. So that's going to wrap it. As always, like to hear from you. I'm on Twitter at dvandenbord, email don@revereasset.com, or phone 855-REAL-WEALTH. Wrapping up Tuesday, December 7th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.